Hello, everybody. Welcome back. Welcome to our tax preparation series tailored to business owners. Today's episode, we're going to be focusing on documentations as needed to file your taxes for business owners. So whether you're a seasoned entrepreneur or a new to the business world, understanding the documentation required for tax season is going to be important for accurate filing and, of course, to maximize your deductions and your credits. So before we jump into this awesome topic, I'm going to begin by introducing myself. So my name is Shane Harris, and around here on these social media streets, I'm also referred to as Shane the Negotiator, and I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. So today we're going to be talking about documents needed to file taxes for business owners. So we have done it previously a couple weeks ago. We had a session on documents needed to file your taxes, but we included that from your personal taxes, and then we spoke a little bit about the business taxes. However, today's session is just for straight up business owners, entrepreneurs, freelancers, whatever you want to call it. If you have some type of business or a profitable side hustle, this is the session for you. All right. So let's begin by the key documents overview. So filing your business taxes can be complex. It can be complicated, as many of you already know, and some of you, it brings you so much anxiety and stress, and rightfully so. Requiring various documents to accurately report your income, expenses, and of course, those credits. So I'll be guiding you through the essential paperwork needed to ensure a smooth filing process. I know oftentimes when I have clients that come to me, I don't care if you guys are coming to me for the first year or if you come with me for 5 years, I get the same question. Well, what documents do I need? For one, the smart response is bring the same thing you bought last year. That's the smart response. However, I realize because tax season can be so stressful, and maybe you have gone someplace before and they didn't require a lot of documents, and you go someplace new and then they require additional documents, and it can make things a little bit confusing. So I'm here to really lay out what you should be bringing to your tax preparer to file your taxes for your business taxes, and things that you should be keeping track of throughout the year so that you can have this on deck and ready to go when it's time to file your taxes. Okay. So let's talk about the income documentation. So this is the documentation that you're going to bring in. Of course, things like your EIN number and your article of organization or your article of incorporation. Those are the things that you should be bringing with you when you go to a brand new tax preparer, because they should be looking those things up to see that you legit have the appropriate business for the taxes that they are going to file. Because I can't tell you how many times I have had clients come to me and say, I have a C corporation. And of course, if I listen to everything that you guys tell me and I go file that 1120 for a C corporation, and then it gets rejected because you don't have a C corporation. Now, you wanted to have a C corporation when you got started, but something happened. You didn't file it correctly. So you end up just creating an LLC and you do not have a C corporation like you thought that you have. Or sometimes I have clients that say, oh, I have a partnership. It's me and another person. And then come to find out it's a regular LLC that they have. They do not have a partnership set up. So that's why when you come to a new preparer, it is very important that you bring your EIN number, your articles of organization, which if you're an LLC, you're going to have this, or a partnership, your article of incorporation, if you're an S Corp or a C Corp, if you're some type of corporation and you have Inc. in your business name, you're going to have the article of Inc. or of incorporation. And this is pretty much is going to detail out the type of business structure that you have. If you're a sole proprietor, of course, you're not going to have any of those things. The only thing that you may have is an EIN number. And you can also have it if it says a sole proprietor, you can be using your social security number, then you wouldn't have any of those things that I just mentioned. But I'm generally talking about those who have businesses that have an EIN number. These are all the documents you're going to need. In addition to, if you're a sole proprietor, you're going to also need these documents. So I don't want to state that incorrectly and confuse you and thinking, well, this doesn't apply to me. It does. Okay. So we're going to begin with the income documentation, as I stated. So we're going to start with number one, your sales record. So you're going to compile all your records of your goods or services sold throughout the year. So if you're selling products, whether you're selling products or your service-based business, you're going to bring all of your income. And to do that, you're not bringing bank statements. I know there's many tax professionals that are still allowing business owners to bring a year's worth of bank statement for credit cards and for your bank accounts. And it's like you have multiple accounts and you can take all those bank statements and give it to them and they're going to file your taxes. But over here at Profit First Taxes, we do not take bank statements as a form of documentation. We don't as a form of bookkeeping. Bank statements is not bookkeeping. Tax preparation is not bookkeeping. It's two distinct services. You have to have bookkeeping or your accounting done before you can file your taxes, okay? Now, there's some preparers that may do them simultaneously, but realistically, how accurate do you think your books is going to be if your preparer is doing your bookkeeping and your taxes at the same time? It's likely not going to be as accurate as you think you are, because going over a year's worth of bank statements, you're going to miss things. And that's why it's very important to do bookkeeping throughout the year so that when it's time to gather your documents to file your taxes, you have everything that you need. So again, bank statements is not bookkeeping. You bring a bunch of bank statements over here, I'm going to give it back to you and I'm going to charge you for bookkeeping because we need to have some type of software set up in place so we can load those bank statements in and we can actually do your bookkeeping, okay? So your sales records, we're going to need the list of your cost of the goods or services that you're going to be selling or that you sold throughout the year. So all the sales that came in. So you need to have bookkeeping already done. So which means you're going to have three different statements. You're going to have your statement of cash flow. You're going to have your profit and loss and your balance sheet. Those are the three statements that we're going to need to file your taxes. Once you have bookkeeping done, those three statements are going to be easy to pull. Now, you should be using some type of accounting software like QuickBooks, FreshBooks, Xero. There's so many that are out there. There's some banks that are even offering bookkeeping that they're doing it automatically. Now, I don't know how accurate they are when the banks are doing it, because if it's computers doing it, there's errors that are sometimes getting made. So it's still very important for you to consult with an accountant or a bookkeeper, someone who is doing accounting, so that they can make sure that the transactions are categorized in the correct place, because sometimes the computer would just put things together that's similar to other businesses, but it may be incorrect for your particular business type, okay? So you want to have those three statements, and those three statements is essentially even more important if you have a corporation. It's important if you have any type of business, but it's if you have a corporation, an S Corp, C Corp, Inc. in your business name, you are a corporation, and you definitely need those three statements to file your taxes, because there's going to be specific things that we're going to need from your balance sheet, like the start of the year amounts from all of the shareholders and the ending a year amount for all of the shareholders, so that we can file your taxes accurately. If you're a sole proprietor, you can probably get away with using a spreadsheet. If you're a sole proprietor, using your EIN number. If you're an LLC, a spreadsheet, you might get away with using a spreadsheet a little bit, but I recommend that you have some type of accounting software, especially if you're starting to be in the high earner stage. You don't want to be playing around with doing this on an Excel sheet and manually doing these things. Some type of software where you can really keep track of these records accurately, where it's pulling your income and your expenses directly from your bank and putting it into the software. And of course, you or your accountant or your bookkeeper or your CPA, whatever fancy word you guys want to use, is going through there and organizing your income and your expenses in a nice little neat folder. All right. So I stayed a little bit longer on this because this is the area where you guys are thinking, oh, I can just do that later. I don't have the money for that. If you think you don't have the money to do bookkeeping, you should not be running a business, because this goes a part of the territory. It's just like if you go to school, you go in first grade, and you're like, well, give me my diploma. I'm ready to graduate high school because I'm done. That's backwards. You're skipping a lot of steps. So if you want to be a business owner, you are a business owner, you are an entrepreneur, you're a CEO, you're a freelancer, anything of the above the above, you're running your business for profit. You, even if you're a nonprofit, you need to have bookkeeping, and that needs to be part of your budget. Is no ifs, ands, or buts about it. You can't be like, oh, I didn't make enough money, so I don't need to worry about accounting on my bookkeeping. Incorrect. If that is the case, that is your mentality. You need to stop running a business right now and go back to getting a job someplace where you don't have to worry about this. But I'm telling you this, and I'm being stern and I'm being direct, because I'm so sick and tired of you guys coming day in and day out, and I'm hearing it around on social media and I'm seeing it, and you guys are not getting it through your thick skulls that you cannot run a business and do not have the appropriate records to go along with your business. That's why so many of you are getting audited. That's why your credits and your deductions are getting disallowed. Schedule C's are getting disallowed. That's why your businesses are getting revoked. That's why you're getting letters, because you are not doing the compliance part of things, because you think a part of running a business is just to make money and that's it. And you have something in the back of your head, and I'm going off on a little tangent a little bit intentionally. You have in the back of your head, as long as I make money, I'm good. Or when I get there, when I make a dollar amount, if I make six figures, or if I make 500K, or when I make $1 million, when I make it, then I have to worry about this. And that is incorrect. When you start your business, you start doing all of these things from the beginning so that it becomes a habit as you go along. Because the more money you make, the more documentation you're going to have, the more compliance things you're going to have to put in place, and the more complicated things become. So you don't want 5 years to go along and then you have to go back and pull up records that you don't even have, because you have to recreate your records from 5 years ago because your taxes was not filed correctly, or you were missing documentation, or that somebody put something on your tax returns that was incorrect. It becomes very complicated, and the money that you think you're saving is going to cost you so much more in the long run to fix it. All right. So now I'm going to get off on that little tangent in my little soapbox, and we're going to go back into the documentation. So again, as I said, you're going to need those sales record, your statement of cash flow, your profit and loss, or P&L, and your balance sheet. Those are the three statements that you're going to need with your records. And if you're a sole proprietor and you have the Excel sheet that you're using, then it's great. But I strongly advise you, no matter what type of business that you have, use some type of software. Stop being cheap. Spend the money, invest in your business, invest in yourself, put it into the budget to do so. All right. You're also going to need those 1099 forms. If you're a freelancer or independent contract, you'll likely receive those 1099 NEC, which stands for non-employee compensation. Those forms is going to be needed from your clients, or also from those contractors that you have worked with, so that you can file your taxes, because it's going to have the income, the sales, the revenue that you've made throughout the year. Sometimes you'll have a combination of both. Oftentimes, especially my e-commerce clients, or those clients who are making 20,000 plus or more in their business, you're going to get 1099s from those merchants. So I know I use CPA Charge, and CPA Charge is going to give me a 1099 for my business. If you make 20,000 or more, that's over that threshold, or 1,000 transactions, or one or the other, they're going to give you that 1099. So your merchants are going to give it to you. Your clients may give you 1099s because they need to file it on their taxes. The contractors you should be giving 1099s to, or they should be giving you 1099s. And those are all the documents you're going to bring. If you have that accurate books, those 1099s should match up to what is in your books. So if, let's say, for instance, your e-commerce client, so you have Shopify, and Shopify have you down for, you made 65,000 in your Shopify store. On that 1099 should say 65,000. In the books should say 65,000. There should not be any discrepancies, and that's why you bring them all, because we need to see if there's any discrepancies, and we need to reach out to you or figure out a way how to make this line up, because you don't want to be off. All right. So we're going to also bank statements. Now, bank statements is only going to be needed if we are doing bookkeeping. If we're not doing bookkeeping, don't send me a bunch of bank statements. I'm sending them back. I'm not even looking at them. Bank statements is not bookkeeping. Bank statements only goes along with bookkeeping. So if you're coming to do your bookkeeping before you file your taxes, then yes, you're going to bring those bank statements. You're going to look at your bank statements to make sure that you have all of your transactions. It's on your in your books if you are doing it yourself. Otherwise, you're going to be giving it to your bookkeeper, your CPA, or your accountant to compare the transactions with what is in the books as opposed to what is in the bank account. All right. So that is the income, and it's other income that you might receive. So you might receive cash. It should be in the books. If you didn't notate it in the books, you want to have some type of record to show what cash that you have received so you can bring all of that. Any type of income that you received for your business and it was for a profit, you received any money. I don't care if you received $10 or you received $10,000, you want to bring in the documentation for that. So let's get into our expense records. So we're going to start with the receipts. You want to keep all your related business expense receipts, including those office supplies and of course the business travel and equipment. All right. You want to have all of those receipts because it's going to be needed to compare the income, the expenses that you purchased throughout the year. And we're going to be able to balance that with the purchases that the receipts is going to balance off with the purchases that you have, especially if you made large purchases. You want to be able to have this to show because it's going to be beneficial when it comes to doing depreciation or amortization or things like that. We're going to need those receipts, especially for those larger items. So we're going to need your office supplies and your equipment, rent or mortgage payment for your business property, utility bills for your office, your payroll records for employees, insurance premiums, marketing and advertising expenses, and those travel and meal expenses. Now, it's other expenses that you're also going to be needed, but this is just a few that I've listed out in terms of expenses that is going to be needed for your particular business. Okay. So let's get on down. I lost my spot here, so I got to go back up. Just give me 1 second. Let me go back. Okay, here we are. Apologies for that. My screen froze a little bit. All right, so credit card statements is also what you're going to need. So it's going to be off those credit card statements often used to track your business expenses. So sometimes you are using credit cards, especially if you're an e-commerce client, you heavily use your credit cards a lot of times for inventory. So a lot of those transactions is going to come from that. Again, the credit card statements and the bank statements that goes along with your bookkeeping. So if you're needing those services, of course, you want to have that so that we can match up the two. All right. We're going to need your loan statements. Again, this goes along with bookkeeping. If you have business loans, interest payments are generally deductible. So we're going to need that. Now, we're likely, if you have books already done, all this information is going to be on your balance sheet, is going to have all of this information on it. So bring in the statements for your credit card, your loan statements, and your bank statements. That goes with the bookkeeping. That's to get your bookkeeping done. You need to bring all of those documents. Once you have those three statements, the statement of cash flow, the profit and loss, your P&L, or your balance sheet, excuse me, all of this information is going to be reflected on that balance sheet. We'll be able to get it from there. Your interest that you paid on the credit cards or your loans is going to be on your profit and loss as well. And we're going to be able to deduct it, get it from there, because all of this stuff is going to go on your taxes. Because as I said, your interest payments are generally deductible on if you have used the credit card for business purposes only. If you use the credit card for personal, then that interest is not deductible. Sorry to say that. So we're also going to need your asset documentation. So assets like your property records, documents related to the purchase, sale, or depreciation of your business property. We're definitely going to need that. We're going to need your vehicle use log. If you are using your vehicle for business, maintain a log for business related mileage. Now, I want to say that you do not have to have the vehicle in your business name to be able to write off the vehicle as a business expense. You can write off the vehicle as a business expense, even if you finance the vehicle using your personal credit. So it's financed to you personally and not the business, but you're using it for business. 100%, you can write off 100% of the vehicle expenses. If you're using 80% of it for business and 20% for personal, well, 80% will be deductible. You're able to write off 80% of the vehicle's expenses for business. Whatever percentage you're using the vehicle for business related activities, you can write off that percentage. So it's going to be very important for you to have and keep that vehicle log, and also to have some type of accounting in place so that you can add in the vehicle on your record, so that you can have on that balance sheet is going to show, or we're going to be able to do the depreciation for the vehicle and the expenses that you have throughout the year, including the mileage log and things like that. So it's the actual mileage or it's the expenses. So whichever one you decide to go with, that is the one you're going to use. It's usually not both. All right. I know there was some bonus depreciation in 2020, 2021, 2022. And even when we did our 2023, no, not 2023, I'm sorry, 2020, 2021, and when we did 2022 taxes, there was bonus depreciation of 100%. So you can write off up to 100% of certain vehicles if purchased within those 3 years window. You can write off 100%. Now it's down to 80% for 2023, and it's going to slowly start phasing out as we go over in the years until it's completely gone, or unless they decide to come back and bring it back again. So having the records for all of those things is going to be important for you, because you never know when it's going to be. You might not be aware that when it's 80%, when it's 100%, when it's 70%. So you want to bring all of this stuff in. And of course, in addition to bringing these in, bring in your tax returns from the previous year, because it may have some carry forwards on your return that we need to place on this year. So carry forward, meaning things that you didn't use up in the previous year, we can now add it to this year. If you have the income, we can offset that by the income that you have. So for instance, you have a carry forward from some vehicle things that I'm just making it up, and you couldn't use up all your vehicle expenses from last year. So you had 20,000 overage. Well, that is going to carry forward to 2023. So when you file your taxes, you can offset that from the income that you have. So now say you have 100K in income and you have this carry forward of $20,000, this 20,000 is going to subtract from the 100K that you have in taxable income. So now you have 80K in taxable income that you have to pay taxes on. All right. So that is pretty much sums up for the vehicle expenses. Now we're going to go to your employment tax record. So we're going to begin with your payroll record. For businesses with employees, all payroll information is going to be needed. All the payroll information. So you're going to need forms like your W-2 and W-3 issued to employees and the Social Security Administrative, respectively. So your W-2 is issued to the employees and the W-3 is issued to the Social Security Administrative. So it's going to have similar information on. It's going to be identical, but one goes to the Social Security and one goes to your employees. So you need to bring both the W-2 and the W-3 when it's time to file your taxes, because if there's a discrepancy on one or the other, then we need to reach back out to you so that you can get it fixed, because you need to fix that. If you file your taxes and there's a discrepancy, there's going to be a problem there. And of course, those 1099s. So we spoke about 1099s on when we were talking about income. This is 1099s for expenses. So the 1099 for your income is if you receive 1099 from your clients and your contractors and etc. These 1099 for the expenses is the 1099 NECs, non-employee compensation, that you issue to contractors that you have paid $600 or more during that tax year. So we're in 2024 now, and we're doing the tax filing for 2023. So from January 1st, 2023 till December 31st, 2023, all of the contractors that you have paid $600 or more, you should have issued them a 1099 NEC by now, non-employee compensation. And you're going to need to bring that as to show for the expenses, because that is going to be deducted. It's going to be a deduction off of the income that you have. Again, these expenses, if you are doing the accounting correctly, all of these expenses will be on your profit and loss sheet, but you still need to bring in those 1099s so that we can cross-reference them and make sure that they line up. All right. So we're going to talk about some deductions and credit documentation. That's right. You have to have documentations for some of the deductions and the credits that you're going to be taking. So number one, we're going to start with your charitable donations. So you want records of the contributions to charitable organizations. Now, if you are filing if you have an LLC or a sole proprietor, where you are going to be using a Schedule C to file your taxes, the charitable donations are going to be deductible on the Schedule A. If you have a corporation, then you may be able to deduct your charitable contributions on the business return if the business paid for it, if the business paid these contributions. If you, the shareholder, paid the contribution individually, then that will go on your Schedule A when you file your personal taxes. So I just wanted to clarify that because oftentimes that is a confusion. Educational expenses. We spoke about charitable contributions in the previous recordings, and we also, on the previous lives, go back and catch the replay. And the replay is going to be, I always forget the name of this playlist, the Business Growth and Tax Mastery series. And it's going to have the charitable donations and educational expenses, where I spoke about that some weeks ago. Educational expenses is number two. If claiming education credits for yourself or your dependents, then you're going to need those education credits. And similarly, you may have provided education assistance for your employees. Of course, the business is going to be able to write it off as a deduction. However, you cannot claim education credits for your employees. They will be able to do that on their own if they paid education credits. But if you provided some type of educational assistance to them because you paid $2,000 for the year for them to go to school or per semester, however you decided to do it, your business can deduct that if the business paid for it. All right. And of course, we're going to need those home office. If you claim a home office deduction, we're going to need the records of related expenses. So I do have a home office expense spreadsheet that I give to my clients that they complete and that they can use to track their home office. So if you need one of those home office expenses, you can send me an email at hello@profitfirsttaxes.com and just put that you want to get a copy of that home office expense, and I'll be glad to share it with you so that you can keep track of your home office expense as well. Of course, you can always click the link and become a client of mine where we can really get into helping you with this stuff. And my link is bit.ly/SD negotiator. That is sitting there on the screen right now. All right. So the home office expense is going to be because of portion of your home that you're using for your home office. You're going to be able to deduct the expenses that's related to that portion of that home. So I did do home office in the previous session, so I'm not going to go too much into details with it, but I am going to say if your home is, let's say, 1,000 square feet and your home office is 200 square feet, then roughly that is around 10% of your home you're going to be using. Your 10% of the home office that you're using. So you're going to be able to deduct 10% of the expenses that you have in the home, like your rent, your mortgage, your utilities, like the water bill, the electric bill, the phone bill, the Wi-Fi, all whatever type of bills that you have that you're going to be able to take as a deduction. However, I did go back in this same business growth and tax mastery series, and I did speak about if you are a corporation, you cannot take the home office expense. It's only for Schedule C filers. If you are a corporation, like an S Corp or a C Corp, you do your home office expense as an employee reimbursement with an accountable plan, and that is going to be tracked a little bit differently. So go back and catch that so that you can hear how that is done. So again, we're going to need your home office expense records so that we can apply those deductions when we file your Schedule C. Okay. Now let's talk about a case study. So we have Elena, which is a web designer, a web design business. So Elena owns a web design business and she keeps digital folders for each category of documentation, streamlining her tax preparation services. Doing so, she was able to quickly provide her accountant with all the necessary paperwork, and accountant means me, Shane the negotiator, ensuring all deductions were captured. So I have clients who are on it. They have follow the things that I've told them, the documentation, the list of things that I told them they would need. And throughout the year, they are keeping track of everything. So when it's time to file their taxes, it's a smooth transaction. They can just check off the list on the things that they need, provide it, easy peasy breezy. And if some of you need a little bit more work, and it's okay if you need a little bit more work, but the downside is that when you know better and you're still not doing better, that is your downfall. All right. So to wrap this up, to conclude this, gathering and organizing your tax documents well before the filing deadline can save you stress and potentially money by maximizing your deductions and credits. You want to start early and consider using a professional accountant to navigate the complexity of business tax filing. And I'm going to say this right here. Oftentimes, many of you are caught up on that title of I need a CPA. You don't necessarily have to have a CPA because not all CPA does taxes. So I want to make sure that you're aware of this. Some CPAs, a lot of CPAs are doing accounting. Some of them are not doing taxes. Some of them are doing taxes. So it doesn't have to be a CPA, but you want to go to someone who is a professional in accounting and also a tax strategist who can really help you with proactive tax planning and not reactive tax planning. And if you go back to last year's Pathway to Financial Mastery, where we talked about tax planning, you would get that relevance on what I mean when I'm speaking about that. So go back and catch the playlist from last year. Pathway to Financial Mastery, look up tax planning, and you would hear the difference between proactive and reactive tax planning. So some teasers for the next topic, and I know you guys are going to want to hear this one because many of you have asked questions about this in the previously, and many of you are doing your businesses the setup in this way. So you are going to want to come back next week and talk about this. So, before I get into next week's teasers, I almost forgot to talk about the inventory. If your business is selling physical products, you'll need an inventory account you're going to need an inventory count. So we're going to need the beginning and the ending year, including purchases and sales. I can't believe I almost forgot the inventory. So whatever the inventory was on December 31st on the previous year is going to be the exact same number for January 1st on that new year. So whatever the amount is in the inventory that you have January 1st, we're going to need the new amount for the total inventory that you have January 31st on that year. And it's going to be subtracted or added to the inventory that you already have. And that is either going to be deductible or is going to add to your income that you have. So keep in mind, if you're running a business and you have products that you're selling and you're keeping inventory, you have to keep records of your inventory because we need the start of the year inventory and the end of the year inventory. And that's generally going to be different. And you're going to be able to take a deduction in that inventory if it's less inventory, if you spend more inventory than you had. All right. So I almost forgot that piece. And so now let's continue on with the teaser that I was going to talk about. Many of you are doing this. The next up, we're going to be talking about holding companies and parent companies, when to choose them, and we'll explore the strategic benefits and considerations of setting up a holding or a parent company structure for your business. As I know many of you are getting into this, many of you like, I want to do a holding company. What's the difference between a holding company and a parent company? Well, come back on Monday because we're going to be going into what the difference between the two, when you should be using it, why I think you might not need to use it, and so forth. So come on back on Monday where we're going to be talking about that. So in closing, thank you so much for joining in on this essential tax preparation guide. If you're looking for more insight, tax strategies, and business tips, don't forget to come on over here, like, share, subscribe to the channel, share it with people, comment on there. If you have any questions, drop it in the comment. You can always send an email. The email is in the description. Your next step in tax readiness begins here. So I want you to guys to, here's the link again, it's bit.ly/SD negotiator. If you are needing of assistance with any of the things that we just discussed, or if you watch any of the replays and there's anything there that I can assist you with, click that link and schedule some time with me. And until I come back with the next topic, and definitely come back on Monday for the holding company versus parent company, where I'm going to be getting into that. So until I come back next time, I hope you guys have a great and wonderful